Hi, I'm Brad Rosley. Thanks for tuning in again today. Today's topic is where you can earn some interest these days. I just got done having breakfast at my local place next to my office, and I couldn't believe it. I had a skillet and a cup of coffee, and my bill was $17. Throw in $5 for a tip, I'm over $20. Imagine if I took my family of 5 there. Holy cow. I can't stop the inflation, but I can tell you where you can make a little bit of interest, although it's not going to actually keep up with the increased prices we're paying for food, for rent, for gasoline, for pretty much everything that you buy. I'm sorry to say that inflation's here to stay unless there's massive changes in government policy, which I don't see coming under this administration. So here's a little bit of a silver lining. Because of this, the Federal Reserve is trying to slow down inflation by raising the Federal Reserve rate, raising interest rates, which could prove really bad because that will slow down everything, the cost of money, the cost of borrowing. And by raising interest rates while we are in a recession, it'll be interesting to see just how much more the economy slows down in the coming year or two. So where can you earn money today? Well, for the longest time when interest rates were extremely low, which caused part of this problem, you couldn't make more than about a quarter point interest on your savings account or money market accounts. So the first place that I'd like to suggest you can look into putting a little bit of money to make a little more interest is the typical mutual fund money market. Those current rates are around 2.25% and rising. The major benchmark that helps those go up or down in interest is the 2-year Treasury note. The 2-year Treasury note is knocking on the door at 4%, a rate it hasn't been at in 15 years. So short-term rates are going up. If you want to lock in 3.9% or thereabout, you can buy a 2-year Treasury note. And if you hold it to maturity, you'll make your 3.9%. You'll get back your money in 2 years. The good news is that you're not going to lose any money there, nor will you lose money in the money market, unlike the stock market potentially or bonds that I'll talk about in a minute. The bad news is right now you're guaranteed not to keep up with inflation. But if you're more concerned about the protection of your money, these are good alternatives. So far I've mentioned money markets, 2.25 and rising, 3.9% roughly for 2-year notes. There's another option that I like. It's called a floating treasury. A floating treasury, I've seen the current yield around 3.1%. It's also a very short-term instrument. There is a tiny bit of price fluctuation in this. But as interest rates continue to climb and as their older notes in the portfolio come due, they'll buy the new higher interest paying paper, and that rate should continue to go up as it has been now for the last year plus. Now, when you go beyond investments like this and you buy bonds, whether it's a treasury bond, a municipal bond, a corporate bond, you may or may not get a higher yield. For example, mortgage, I've seen Ginnie Mae rates over 4%. The 10-year treasury bond now is 3.5%. Note that's actually lower than the 2-year Treasury note. That's usually a sign of a recession. I noticed that a corporate bond fund from Vanguard was paying just under 3%. I noticed that there was a high yield bond, ETF, exchange traded fund, yielding just over 6%. But when you buy these bonds, keep in mind they are not risk-free. It's real simple. Bond prices move the opposite of interest rates. So if interest rates go up, bond prices go down and vice versa. So pretty much for the last 30 years, interest rates have either been coming down or been level. So you haven't lost any money on your bond price. You've either pretty much stayed the same or you've got a kicker. You've had an increase in your bond value while you made interest. Well, now I've seen some of these corporate bond funds down 10 or 15% in price this year, far outweighing the 3% dividend yield they might be paying. So there is real risk in bonds. If you have a portfolio now of stocks and bonds, you got double whammied. Stocks have gotten beat up and bonds have gotten beat up just as bad, in some cases worse. So be very careful. But remember, if you're going to buy individual bonds, you can hold them until they come due. And if it's the U.S. Treasury, you're guaranteed to get your money back. If it's a corporate bond, it's as strong as the corporation that's backing the bond. So if you buy a large company, solid balance sheet, you're going to get your money back. High yield bonds do have some risk. That makes them especially attractive to hold in a mutual fund or exchange traded fund type portfolio. So if one fails, it doesn't kill you if that's the one you happen to choose on your own. But all those come with risk. I want to give you one other idea I've talked about earlier in a video, and that's called I-bonds. I-bonds are the best of both worlds. They're actually based on the current inflation rate. They're backed by the United States Treasury. They're updated interest rates every 6 months. The current rate is 9.62. That'll come out with a new rate on November 1st. That rate's good for 6 months. But your principal is guaranteed by the U.S. government. If you hold the bond for more than a year, you won't lose any of your principal. The interest is reduced, however, if you don't hold the bond for a certain period of time. You can learn more about those in my other video. So I'd like to emphasize the point again. Look around to make a higher rate of interest on your savings, because there's new options now, or old options, I should say, that are paying much better interest than they did prior to this. I noticed this in some people's account where they were only making 0.25% on their savings, and they could have been making 2.25% or more. So you might as well take the extra interest while you can get it. I hope you'll give me a like. If you have questions, let me know. If you find the interest rates on different vehicles that are higher than the ones I'm mentioning, please let me know. I know there's CDs out there paying 3% now also. I should have mentioned that. But take a look at my channel, subscribe, give me a thumbs up, share, like, you name it. I really appreciate your time. I wish you very well in your finances. Thanks a lot for listening. Have a great day.